Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Fidectis. Go to www.fidectis.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me is co-host Johan Oberg. Johan, how's it going this week?
It's another great week, Chris. Just realized I'm starting to follow the Olympics, which has now, we're halfway through, or at least a bit through it. And I'm always surprised when we look at the Olympics, because suddenly we're now start tracking things that I've never watched, apart from every fourth year. So it's an interesting part, being a big sports fan, watching the Olympics, having the TV on in the background, and watching sports that I never heard of before, and getting excited. Not as excited as the Insider's Guide to Energy, but still.
So I've been watching the Olympics too. The problem with Insider's Guide to Energy, and even like the show we're about to jump into, is I look at that and look at all the energy consumed and all the folks flying over there to be in the Olympic Games. A fantastic thing. I am certainly a fan. I certainly watch it, so I'm not speaking out of both sides of my mouth. But if you're blowing snow and creating snow where there's no snow, and you're building all these facilities for a very limited use, and athletes are flying in from all over the world, I kind of wonder what the carbon impact of this event is.
It's probably a difficult thing to say. It's the green events or the green Olympics. It's probably a bit harsh to push. But maybe we can get one of them on the show later on.
I'm kind of curious about how you make that green, but yeah, it's kind of fun. This is a first for the show. We're bringing back a guest. We had a guest who is very popular with the audience. He made some bold predictions last year. I think it was last June when we had Lawson Steele on. And I recall him saying that although he may be right, he may be wrong, but end of year he was hoping for 110 carbon prices. Not particularly far off, but not quite there. So I'm really excited to see what's happened, because I think we met before the COP conference last time. So we expected the EU to do some things to change the market there as well, if I'm not mistaken. What are you thinking?
No, but I agree. I think it's, we had the discussion, will it hit 100 or not, and when, which I thought was quite interesting. For me, the whole thing was fairly new. But since then, I've been tracking as much as I can around this, followed Lawson also on social media, where he's quite active, and kind of starting to getting quite into this one. And I have plenty of questions. For me, there's also a lot of this, where do we draw the line with politics? And we've seen a few things with France, for example, lately that interesting to hear his views on.
Well, we'll see how politics plays a role in the pricing of carbon. But rather than speculating, let's bring Lawson Steele to the program. Lawson, welcome back to Insider's Guide to Energy.
Hey guys, good to see you. Thank you for having me back. First of all, I have not a clue what the carbon emissions are of the Olympics.
We were hoping for you there, Lawson.
Yeah. My expertise doesn't quite stretch that far.
Yeah, I didn't figure you would. I just kind of, in the back of my mind, I've been watching that, and I see all this thing, and been sitting with my son each evening watching the skiing and the ski jumping, and really been getting into it. But in the back of my mind, I'm like, I don't think that snow looks natural, and therefore there's probably a fair amount of energy to make all this happen. That's what happens when you work in energy. So let's talk about carbon. So much is happening. I read an article, I think, in the last 24 hours about shipping now being counted into carbon in the EU as well. Tell us what's going on.
As you were saying in your intro, carbon's now nibbling on 100. It's at 98 today as we speak. I've got a forecast of 110 for April. And again, just to sort of put into context of what I said before, that is a base case, but in reality, I think it could well blow through that. And since we talked last year, I put up my forecast now to 150 by sort of beginning of next year. So again, that's a base case. Carbon needs to in reality has to be much higher than that in order to incentivize industry to make it worthwhile financially for them to actually invest and reduce their carbon footage. Yeah, I mean, it's all go. We're getting to some interesting levels now. People thought we'd never ever get here, but here we are, kind of thing.
150 mid-year, is that what you're saying? When are you thinking?
Q1 next year.
Q1 next year. And what factors are driving it? On our previous episode, you kind of went through things that you thought were going to force it up to 100, 110. What are the elements pushing it up, making you predict this?
The biggest element is the fact that you got massive supply cuts, right? So you got this mechanism in place which is reducing the amount of emissions, the amount of allowances, which are either come through auction or through free allowances, and they're being reduced by 300 to 350 million per annum on a sort of 1 billion level of emissions. So this is pretty radical. And that means that we have a supply deficit, i.e. supply being a shortfall of demand of 25% for this last year, which you end up complying on the 30th of April each year. So when I say this year, I'm talking about 2021, bizarrely, because we're not yet at 30th of April. So 25% short for that year. Then this year, I'm getting to confuse the hell out of people. For 2021, that's 25% short. For 2022, it's 35% short, but you're also having to buy the 25% which you couldn't deliver in 2021. So there's a cumulative 60%, and it gets worse and worse and worse. In fact, it goes through 100% shortfall cumulative by 2024. That's the biggest thing. But then you also have noise, as always. There's a lot of noise. Even EDF, Electricité de France this morning, the big nuke producer in Europe, has cut its forecast for power yet again, which of course means that that'll have to be replaced by thermal power, which emits carbon, which means there's more demand for carbon permits, and so on. So you've got that in the background. You've also had, as we well know, the huge increase in gas prices. Not only the fact that they increased in price, but actually that they physically are not available. You cannot buy as much gas as you need, which means that the gas electricity producing plants are not producing, and therefore the coal-fired electricity plants are producing, and they of course produce twice as much carbon as the gas-fired. Kind of interesting. It certainly is additional demand, but at the end of the day, what's really, really important is the supply.
How much does the recent news, I think I read in this morning's news that Germany and the US were not totally aligned on the pipeline coming from Russia. How does that implement your forecasting? Is that just noise right now, or is that actually into some of this consideration, whether there's a pipeline or not to Germany for natural gas?
Yeah, I mean, that's about the whole supply equation of gas into Europe, of course. The supply of gas into Europe comes from Russia, comes from obviously indigenous supply in the North Sea. It comes from LNG. Now, the LNG is mostly being siphoned off to Asia because simply, there's shortages there as well, and they're prepared to pay more. But the US is obviously not keen for Russia to be allowed to export its gas until it withdraws, hasn't penetrated, but you know what I mean, get away from the Ukrainian border. And in turn, Biden is talking about allowing more or pushing more gas into Europe from the LNG. But to put it into perspective, what it means for carbon, back in January 2018, when I turned bullish at €8, I said what's going to happen is that the coal plants in Europe are going to switch off because the carbon price is going to get to such an extent, which is going to make that coal gas switch happen. And that's what happened in 2019, 2020. Now we've had this retrenchment from gas back to coal because of the lack of gas availability. To put that into context, we're talking about 30 million tons or so out of a total deficit for the year of 200. So yes, it has an impact, but it is really not the story. So I'm assuming that we have that flow back towards gas, i.e. that the 30 million comes back and that gas produces, and that somehow, the powers that be sort out the gas supply. But it's not the real driver by any stretch of the imagination. But there's an awful lot of noise in the market about, where is the gas coal abatement price and so on.
So in terms of recently, there's tabled on the European Union in terms of classifying nuclear and gas as renewable or as green. I know Sweden, for example, has objected. France is driving it. Is this having an impact? Because it's obviously opening up, and you mentioned EDF now reducing their nuclear. If that's financial or not, I'm not sure. But where do we see this? Because sooner or later, this becomes a political game as well, wouldn't it?
Yeah, I mean, well, first of all, just to nail the EDF issue, the issue with the EDF and the nuclear plants at the moment is the fact that they do a 10-year maintenance, rotating 10-year maintenance, and there are 5 nuclear plants which were under that 10-year maintenance, and they discovered cracks in the welding right at a sort of critical juncture. So they had to take those, extend that outage, and B, look at all the other nuclear plants as well. So there's a rotating sort of issue there. So so that's it's and then the reason they're doing that, of course, is because you've got the French Nuclear Safety Authority who comes and says, right, one thing is having electricity or not having electricity, but what we don't want is a blow up. So this is not unusual with EDF. There have been issues in the past, and here we are yet again. As far as putting gas and nuclear into the EU taxonomy sort of umbrella, in other words, they're allowed to be considered to be renewables. The reason fundamentally is that power cannot just switch off thermal power and nuclear power, because renewables power today, although it's utopian, does not deliver the baseload electricity level which you require. So in other words, because it's intermittent, because either the sun is shining or it's not, or the wind is blowing or it's not, you can't rely on that renewable technology. So you can only operate that renewable technology if you have the backup behind it, like a gas plant or a nuclear plant, to actually allow that to essentially operate. So alone, with the current technology we have today of batteries, essentially, which is the backup or the way that you convert that renewable energy into more stable sort of base load, that technology is not available today. It's good for peak and super peak, but not for the lower end. And therefore, you need to have your more investments in gas and more investments in nuclear, particularly as the coal plants are switching off. The Germans are closing their nuclears. So the renewable element is not there today to be able to absorb that. Will technology change at some point? Probably, I hope so, but it's not there today. So what does that mean for carbon? It doesn't really change the equation, right? Because we have the capacity we have today. I'm assuming that we have more renewable penetration in my demand or emission forecasts. I assume the nuclear closures in Germany. I have the tabled lignite closures as well. So it's more, I think, the fact that it's including in taxonomy means that actually investors can now put money towards that. Whereas if it wasn't green, just no way, Jose.
And you mentioned in your earlier conversation, if I recall from our previous interview, a little bit how the carbon market works. April 30th is kind of a magic date. Yeah. How big is surprise do you expect in April 30th? Or is it pretty transparent based on just understanding who's burned coal this year, who's burning oil, what's happened to supplies for energy production? Or could there be a surprise when the companies come to the table and clear the slate for the year?
Yeah, let me just recap that April 30th first. So the way the EU scheme works is that every 30th of April you have to go to your government cap in hand and say, right, forgive me, I've emitted 10 million tons. To which you then have two options. You either deliver 10 million allowances to clean the slate and move on to the next year, or if you don't have the permits, you have to pay a penalty of 111 euros per permit and still deliver the shortfall the following year on top of next year's normal emission level. So that's really key to the whole thesis because if you're going into that 30th of April, if you are 25% short, which is kind of what I think is a shortage, that's what my numbers say, then what you're going to do in the first instance is to say, okay, what I need to do here is to buy these allowances to avoid, in the first instance, that penalty price of 111. So you keep on trying to buy the permits, there aren't enough to go around, the price goes up, it gets to 111. When it gets to 111, you then realize that you still haven't bought the permits because there is a 25% squeeze. And now you realize that not only do you face a penalty of 111, but you also have to still buy the underlying allowance for delivery the following year. And that, of course, is now trading also at 111. So actually your opportunity cost is 222. So therefore, knowing that in advance, you will try and buy permits. There aren't enough to go around. The price goes up to 222. When it gets there, you think, hang on a minute, I now don't have the permit still. I now have to pay a penalty price of 111, and I've got to buy the underlying, which is trading at 222. So actually, it's 333, my opportunity cost. So it's gone from 111 to 222 to 333, and you can take that off to infinity, right? So that's the whole April 30th issue and the pricing. But in order to answer your question, Chris, I mean, as we get to the 30th of April, there are compliance players who are still clearly short because it's 25% squeeze. There are compliance players out there who don't hedge, who are only allowed to buy or only bother buying in a just-in-time basis. There are others who will begin to awaken slightly earlier, and there'll be others which have hedged already. They're probably within the 75% bracket, but there's going to be a 25% squeeze. So we will see volatility as we get to the 30th of April. As ever, as I've said before, judging the exact timing of that is never particularly easy. But hell, we're now in February and April. We've got what's that? 3 months, less than 3 months.
Have the energy traders gotten better at hedging or understanding this process? I believe that there is probably still a learning curve going on for many. Are they tightening their systems that they figure this out? Is it less surprising at the end of the year as years go on?
I think my sense is it's getting a bit better in terms of more educated. But I still think that there's a massive amount of poor knowledge, and part of it understandable because there are industry as a whole is still getting 85% free allowances, so they're only having to buy 15% of their pollution, and for many companies, a lot of companies, the carbon price is irrelevant today, or the carbon cost is irrelevant because they're paying 15% times today's price of, call it 100, that's 15 euros, not 100 euros they're having to pay. So for a lot of companies, it's irrelevant, and it's So I think it's improving, but I still think there's an awful lot of misunderstanding, and not misunderstanding, just not bothering.
So if we look at that a little bit, which I think is quite interesting. One is hedging, of course, and especially from a trading perspective. But you mentioned this is also a cumulative year by year for some of the organizations. And even if it's definitely not in the past, maybe it's getting a little bit more relevant now because the cost is going up. But what are they going to do? What are organizations, the ones who haven't done anything now, is it going to hit them hard, or are they hoping for other decisions to kind of make this disappear?
I don't know what they're thinking, to be honest.
That's a good.
What I can tell you is that I spoke to in the last couple of months. I spoke to over 50 companies, industrial companies from all spectrums, from a cork manufacturer to a drinks to cement, you name it, kind of thing, even to gaming. And these guys, and I spoke to them more about getting them to understand what the EU ETS carbon scheme is about, and to make them realize that actually it is a much better alternative for them if they want to reach the net zero targets. And what was interesting is that normally when you speak to a number of investors or whatever, somebody says, "Oh, what are people saying?" And they kind of want a summary, right? And it's difficult to summarize because everybody has a completely different point of view and everything else. But with these guys, unanimously, apart from one, I guess that's not unanimous, but virtually all of them were saying, okay, we're thinking about our net zero targets, but we haven't set them yet. We're thinking and trying to measure our scope 1, 2, 3 emissions, but we haven't quite got them yet. And we know that once we reduce our emission levels to whatever that is going to be, either the residual level beyond which you cannot reduce emissions any further, then for that we know that we can offset with voluntary carbon offsets. So by the time I then finished speaking to them, they realized that actually there is an alternative option which is far better, which is the EU ETS carbon permit, which is regulated. The voluntary carbon offsets are unregulated, full of, people making huge amounts of money in this, which is why everyone's flocking to them, making an awful lot of noise. But you've got 6,500 projects plus, which are unregulated, are often fall down on ESG compliance. Bottom line, without rabbiting on a lot, I think that there's going to be some very nasty shocks for those companies which invest in voluntary carbon schemes, thinking that's going to offset my carbon, because the project may well not deliver what it's going to deliver, what it's supposed to deliver. And of course, a tree takes 15 years to grow, by which time the guy who put you into it has probably long disappeared into the sunset on his yacht. Whereas the EU ETS scheme is fully regulated, fully ESG compliant. Okay, I'll give you one final point on this, is that there's a group of pension funds called the IIGCC, which is a terrible acronym, but anyway, you'd have thought that the top 250 pensions in the world could come up with a better acronym than that. I've even given up thinking what it means. But the IIGCC is 250 top pension funds in the world. Together, they got $33 trillion under management. So this is huge, and they have decided that in their quest to reach net zero, they will not recognize voluntary carbon offsets because they're unregulated, but they will recognize emission trading schemes, which of course are regulated, and of course the EU completely dominates that. I can't remember what your question was, but I hope I've answered it.
I hope so. I wonder what learnings you've had since either we last spoke or in the last year. I'd imagine your models are continuing to evolve. You just gave an example of maybe a better mousetrap or a better place to put your bet. What have you learned, or what kind of things can you share that maybe have changed in your thinking in the last 6 to 12 months based on current market conditions or just overall changes in carbon?
The thing is that since 2018, because I spent 6 weeks thinking about it, not much has changed. Because, as I said, the real dynamic behind this market is the fact that the EU decided to tighten up the auction level to create a deficit, and that is mechanical. So the only thing which really happened, I guess, the major thing which happened was, of course, COVID, when demand emissions fell through the floor, which left a surplus for the year. But the interesting thing about this scheme is that if you get a surplus, that means that the withdrawals in the subsequent years are that much greater. So it's like a counterbalancing mechanism. So it's what's changed is just all the noise about gas and coal, and that we've got an extra 30-40 million tons of demand for 2021 spilling into 2022, but then that reverts in 2023. I guess. I mean, the big thing I guess I'm missing is this whole Fit for 55 package, the Green Deal, which I think was murmuring and bubbling away. I can't remember if it had actually been published or not by the time we spoke, but certainly it's already been discussed. And that now has been, the proposal's been tabled. There's the big debate flying around about it. For me, it's kind of interesting, but it's not going to change anything over the next 3-4 years. It could make things worse in the next three years, because I've assumed it starts in 2024 and it could start in 2023. But all the discussion is about, how are we going to tighten this system to achieve the 55% goal instead of the 40% reduction on 1990 levels. And interestingly, although the 55% target is the EU overall target, the EU ETS scheme only covers 40% of emissions. They put the brunt on the EU ETS scheme. The EU ETS scheme has to deliver a 61% reduction to achieve the overall European level of 55, which means obviously the rest of the other 60% has a less, is it 40%, whatever the number is. So they're putting a lot of onus on that. What's changed? Well, the price has gone up. So that's about it.
So one of the things we touched on last time, especially with China, but also now with the UK, is that we're seeing more and more different schemes in different countries, where the European has its own, and now the UK is starting on the carbon trading, which somehow does it level out, or does it create different competitiveness between the countries, which then goes back to this kind of not fair kind of a thing from a corporate? Or how does this work, especially now, maybe between, we discussed China, but maybe even more now with the UK and Europe?
Yeah, I mean, I think, first of all, I don't believe we'll ever get a global carbon price. So I just think there's too much politics and blah, blah, blah. I'm beginning to sound like Greta, aren't I? But what I do think is going to happen is that you're going to get more and more countries coming up with their own carbon schemes. Now, first of all, within UK versus EU, I think that once all the Brexit divorce toys are thrown out of the pram, eventually we'll get a relinking, because ultimately the UK wants to trade with the EU and the EU wants to trade with the UK, and they need to be on the same carbon footing to do that. The carbon schemes are virtually mirrors of each other. The UK helps set up the European one. So it just makes sense for those prices to converge, and the schemes to in other words, to be able to allow UK allowances to be utilized in Europe and European allowances to be utilized in the UK. So I think that we'll end up with a pretty close, or if not identical, price. So the other schemes is kind of interesting. So I'll just talk about what we call the Carbon Border Adjustment Mechanism, CBAM for short. So the Carbon Border Adjustment Mechanism is put in place precisely for these issues, where if you have a non-European entity which wants to export into the EU, of course it'd be foolhardy to allow them just to come in without paying a similar carbon cost. So the CBAM is all about that, saying, look, if you want to come and sell your goods in the EU, that's fine, or the usual stipulations, but on top of that, you need to be on the same carbon footing. So therefore, this is a proposal which is saying you will have to account for your emissions in the same way as a European company does. So, you would have to buy carbon permits. In this case, it's going to be notional carbon permits, and deliver accordingly based on the carbon output or emissions of your widget. So it's going to be it's not going to be part of the EU ETS scheme, but the price of the carbon permits are going to be the same. So that's the idea behind it. In reality, there's a few sort of repercussions or additional sort of corollaries of that. One is that if you're doing that, then you can't also give free allowances to EU industry, because then that becomes protectionism. So that needs to be wound down. The current proposal, which is the first proposal, is that free allowances will reduce by 10% per annum from 2026 onwards. So that by 2035, 2036, there'll be zero free allowances. That to me is just way too slow. That is still going to be protectionism. But anyway, I guess it's the first proposal, so they need to get people on board before they sort of accelerate that. Then what was the other thing? The other thing, I guess, is not carbon border adjustment mechanism per se, but for those industries which can, like ArcelorMittal, decide, you know what, I'm off. I'm going to go do this in Morocco, and I'll export into the EU. Those guys, the EU looks at those guys, the term is carbon leakage, and they don't want those industries to go and do that, because from a planet's point of view, they're going to produce the same widget at the same carbon intensity, if not higher, because of more lax rules. So it's done the planet no favors, possibly worse, and they've lost an industry. So those guys are getting 100% free allowances, so they don't have a carbon cost.
So I think I've read as well about those plans that it's viewed poorly by both China and the Biden administration in the U.S. because they see it bad for trade. Is that something that you hear or feel? I reading things like that.
I knew there's something else I said, so good. Thanks for the question. But one of the interesting reaction of countries to this CBAM proposal is not, you must be joking, is actually, what can we do to ameliorate that cost? And the answer is to set up your own scheme. And by the way, if you set up your own scheme, you're going to get amazing revenues.
Okay, so it's actually seen as a plus. It's a tax revenue potential or revenue potential for the governments that might be objecting to it.
Well, the first thing is that it's a catalyst, right? So it's perfectly, you can't really argue against it. If I'm paying my carbon cost and you're not, and we're in the same market, come on, that's not fair. So that's what it's, so it's difficult to argue against. But then the soft sort of sell or the dollar sell to them is to say, you set up your own emission trading scheme. We today, the EU, at today's prices, are getting 60 billion euros from sales of the allowances, which, to put into context, the UK Brexit bill is 40 billion. So this is 60 on a recurring basis, not a one-off. So it's huge. And put it into another context, the EU spent 750 billion in sort of rescuing COVID, rescuing the economies from COVID, right? So it's a tenth of that, give or take. And if I'm right in my price forecast, this is going to sort of double or triple. And that money is collected by the EU and distributed to 27 finance ministries. So even though the likes of Poland make an awful lot of noise against this, these guys are getting the biggest share, 17.5% of that, which is around the sort of 10 billion level. Much more than that, isn't it? So no, that's about right, 10 billion. So this is a huge source of revenues. New source of revenues.
So in terms of, that's one market. I can understand the European market where you can control it, be that even subsidies to Poland, etc. But as you mentioned before, if you move your organization to Morocco or just borderline outside of Europe, then suddenly you'll be able. Is there, maybe a stupid question, but are there any plans or maybe already existing some kind of carbon tax? So if it's produced somewhere else, it's going into Europe, and you know what, you're not part of the scheme. This goes against competitive rules. So if you're going to do this outside and you want to sell in Europe, we're going to hit you with that's 10% carbon tax.
Yeah, not a carbon tax, but that's what the carbon border adjustment mechanism is. So
So it becomes okay. So
So if you call it a tax, you can't do it because then you contravene Article 20 of the WTO. But it's an adjustment mechanism, and for that, it does work.
So in a layman's work, it's a tax.
Yes.
Are volumes significantly increasing? Are there more instruments and tools now for carbon markets that you're seeing in the last year or two? Is there the trending up? I mean, we see the price going up, but is volume going up of the carbon industry as well, or trading?
Trading volumes, yeah, they're definitely going up. Yeah.
And is it mostly speculative, or who's driving this volume, or is it the users that suddenly realize they need to be buying carbon offsets?
I think it's difficult. I think it's everyone, right? But the current, the current value of the global carbon market, and there's countries which are quoted, and the EU takes the lion's share, is around 900 billion at the moment. Right, so it's getting on for $1 trillion. It's big. Now, to try and, it's very difficult to say how much of that is speculative, how much is corporate, because corporates play with futures too, right? So you can't distinguish. But I don't think you can sort of attribute, 900 billion to just speculators, which is what some people like to do.
And then the price points that you're talking about, that, I guess, insight is just based on the trends you're seeing. So you're basically, what I've heard you say is your formulas really haven't changed, but the percentages changed. The rules have changed slightly, but the formula stays the same. Are there any other indicators that are driving this, why you're so bullish on this?
Yeah, I mean, ultimately, demand and supply don't intersect, right? That's the 25%, the 35%, 100%. So you can't do your economics 101 where you draw your demand, your supply, and you get your price. Nor is it correct to say, well, the abatement price, the average abatement price, the price at which carbon makes it worthwhile to invest and reduce your emissions. You can't say the average abatement price in 2028 is 100 for the sake of argument, and we'll do a present value of that today, and that's the carbon price today. That's just bullshit. Because carbon, the demand and supply just don't intersect. So you need to look at it, in my view, from a top-down way. And I looked at it three ways: politically, corporate, and some analysis we did. So politically first, in about just before May last year, I was beginning to hear that some European MEPs understood that the abatement price or the carbon price required for industry to do something was 2 to 3 times higher than where it was, which was 50 at the time. So it needed to be 100 to 150. So I'd heard that through the sort of rumor mill kind of thing. But then we had Frans Timmermans, who's in charge of climate change, Ursula von der Leyen's right-hand man, publicly state that the carbon price needed to be well north of 50 euros. So that was quite surprising. Then you have Germany with the Greens now as part of the government. They're talking about having a floor of carbon of 60 euros. Not obviously near where we are today, but it's kind of interesting because these numbers were just unheard of when I kicked off in January 2018. And then you've got the European Greens talking about 150. You've got the Bank of England talking about 150. You've got Norway talking about 200. Right, so big numbers, way north of where we are. Secondly, from a corporate point of view, you've got one of the most efficient chemical companies in Europe, BASF, stating that they need to see carbon at 140 before it's economically worthwhile to invest in abatement technologies, which means really they need to see carbon above 140 and consistently so to make it worthwhile. You've got Heidelberger Cement talking about 120. You've got some of the shipping companies talking about 150. You've got Swiss Re talking about 200. So again, all these numbers way north of where we are. And then the third element of that is that back in March last year, I asked the 150 analysts at Berenberg to look at the 900 companies covered on the European side and say what happens if carbon goes to 110 this year, which is my old forecast. Astonishingly, actually, of the 900 companies, only 26 were significantly impacted. Right, so that's the first thing. And secondly, he said, well, what happens if you want to pass that through as a price increase to your customers? What price increase do you need? And it was remarkably low. Airlines was the biggest; they needed 8%. You had chemicals needed 5%, and cement needed 2%. So clearly, 110 was not going to cut the mustard. So whichever way you look at that, politically, corporate, or the analysis we did, carbon needs to be way higher. So it's what is difficult is actually giving you the precise number in my head, or getting my head to tell me what the precise number is. 150 I can easily see, but I can also see it blowing through that quite happily.
But if that's the case, and some of the larger consumers or the corporations looking somewhere between 140, even as you said, Swiss rate at 200, if even an impact, would you say that it works, or is this just another income for the countries, and really has no major impact on what I think is the pure goal of this one, is to drive towards a CO2-free 2050 or 2040, whatever it is?
Well, the reality is that for the last 15 years or so, it hasn't worked. But since they put in the MSR, it is working because under normalized coal gas conditions, we did have that switch from coal to gas across the whole of Europe, which I predicted back in 2018. And power produces half the emissions of the EU ETS industries. So that 50% came down significantly. Of course, you've got a temporary retrenchment, but that's, as we discussed, due to lack of gas supplies, but that will sort itself out. And then you've got a gulf, right? Because the next level is way up here for industry to do something. Why is it that high? Because they're getting 85% free allowances. If they got 0 free allowances, it'd be way lower, right?
Yeah.
So I think, but yes, if you get the price up to that, 140 in the case of BASF or whatever, then that will trigger them to start thinking. Of course, they need, as I said, they need to see it above that level, sustainably so, for them to actually say, okay, we can rely on this now. So it takes time. And of course, it'll take them 3-4 years to sort out, the practices and everybody else. So but you need to get that carbon price up to a level. So first of all, yes, it does work. Yes, it has worked with power, and yes, it can work with industry. But you need that price to be at that level, which triggers that's behavioral change. And there's no point at all saying, oh, we're going to have a nice gentle increase in the carbon price to 2030, so that by 31st December 2030 at 11:59 p.m. industry says, hey, I've just reduced emissions by 40%. That's useless. You need to get that price up now to trigger that behavioral change, and hopefully get that emission reduction happening sooner rather than later. Because if it happens, say, in 3 years' time, in 2025, at least you then have 5 years of lower emissions than if you wait to 2030. So yeah, I mean, it has not worked till 2019 or so, 2020, but it is working, but it needs to be hard to really kick in. And don't forget, this is what they call their cornerstone policy, right? Mm-hmm. The actual is the prime weapon of, even though it's only 40%, even though it only covers 40% of European emissions, it is their prime weapon to achieve the 2030 targets. It's not the only weapon, but it's the most important one. Yeah. And very lucrative too.
Of course.
Well, it sounds like to me as a layperson, or you mentioned a pension fund invested in this, that there's certainly a ride up for a number of investors to ride along this. It almost seems somewhat predictable. Obviously, everything can vary, and there's a lot of risk because you talked about your 3 different elements that need to align to keep this going. So assuming Lawson doesn't want to retire one day, when does all this work and Lawson no longer has a job talking carbon? Because I have to assume at one point we've done what we wanted and we're no longer having to restrict carbon because it got so expensive that we had alternatives. So is that 2050 in your vision, or when, if you were going to work forever, when is that retirement point because the market's gone away?
I guess once we get to net zero, right? So, that requires not just a carbon price, but technological change as well.
But this program's designed to do that. So I would assume even at net zero, you're still net zero, and you still have a carbon market right up till that point, right? And so we're targeting that.
Yeah. So in other words, it's going to take a long time. In theory, the scheme at the moment runs to 2030, but in practice, they would extend it. At the moment, they're worried about making sure that this phase, this decade, delivers what it's meant to do. But if you're reducing your emissions by 55% by 2030, that's not enough to solve the climate issue. So, I think it's going to take longer than that. Well, it's definitely going to take longer. I'll probably be dead, let alone retired.
No, I think it's great. I think we're running up for time. I just have one final question that I'm interested. I'm always going back to the corporates, so I have another thing. I saw that our Larry Fink of BlackRock came out again with a CEO letter that he comes out. He's very bullish on sustainability in terms of how and where they invest. You mentioned the pension funds that's holding a lot of a stake in this, especially with their capital. Do you see more of an active approach also from the likes of BlackRock and also from the pension funds to push this even further, and not just looking at the specific CO2 price in order for organizations, the ones who hasn't started, to actually get going? Because it feels like it's a little bit of a play around with the numbers now before they actually start doing this transition. We start thinking differently.
In terms of forcing industrials to change differently, you mean?
Correct.
Yeah, absolutely. I mean, it's if you look at COP26, it was pretty much a disaster, right? But an expected disaster.
Yeah.
Achieving nothing. And so ultimately, it's not the politicians are going to get this done. It's going to be investors and corporates, and going back to that IIGCC mouthful of 250 pension funds, when they got $33 trillion under management, and they say to you, I'm only going to invest in you if you reduce your emissions, then you got to sit up and listen, right? Yeah. And that's all part of ESG investing. So it's not a fad. It's every conversation I have now with investors and corporates is ESG is mentioned and discussed. So yeah, and undoubtedly there's more and more push, and of course as you get more and more push to do that, corporates will realize that. Let me just go to tangent. So if you're a corporate, I mentioned before that they're also trying to work out their targets and so on. But if you're producing, your emissions are 100% today, 100% of whatever you choose, just call it a number 100. And you know that you can reduce your emissions by 70% by 2030, and then that remaining 30% is your residual emission, then what a lot of corporates are thinking about is that, okay, they'll publish their net zero targets, saying they're going to reduce their emissions by 70% by 2030, say. Then they're thinking that they can then offset that 30% residual in 2030. And I'm saying to them, absolutely, you can do that. You will get no recognition for that at all in your share price. And actually, probably while others are doing more, you get penalized. Funds will flow away from you. Your best strategy actually is to offset that 30% today by EUETS carbon allowances. You can try the voluntary carbon market, but good luck with that. But at least this one does what it says on the tin and is recognized by the IIGCC, which are the guys who are going to invest money in you. And also, while you're on that trajectory from 100 down to 70, the best thing you could do is to actually be carbon neutral on that trajectory and buy carbon permits to offset that on the way down as well. So if you did that right up front, you would have a massive inflow of funds. So interesting dynamics flying around.
Well, it's been an amazing conversation today. I really enjoyed this last tangent. That's kind of eye-opening to see where the strategy would be for business. Any final thoughts you want to share with our audience? You've made some predictions, but anything else you want to share today?
Yeah, I mean, where am I? I've got 110 for April 30th. I think we can blow through that. I've got 130 for the year end, which is probably conservative, 150 into next year. But as I said, all of that is very much at the conservative end. I think we're probably going to go exceed that and then come back at some point. So yeah. Anyway, but I have stuff on LinkedIn and Twitter, so everybody wants to follow that stuff. Happy to do that, or of course here.
So last 2 seconds, if you were not conservative but very bullish, Q1 next year, what would you say?
We could be in 200 plus, I'd have thought.
Awesome.
Cool.
Well, thank you so much. It's been a pleasure as always. We appreciate you coming back in the program and sharing with the audience. Thank you, Lawson.
Sure, my pleasure. Thanks for having me.
Thanks.
And for our audience, you've listened to another episode of Insider's Guide to Energy. I hope you've enjoyed this conversation as much as we have. If you have, share it with your friends. Don't forget to like it and certainly follow us and give us thumbs up wherever you get your podcasts. We'll talk to you again next week.